Okay, so welcome to this intro to Meteora. We're going to learn on this tutorial about dynamic liquidity market maker pools. First, what is Meteora? Meteora is a decentralized finance DeFi protocol and decentralized exchange DEX built on the Solana blockchain. The idea is to offer dynamic, capital efficient tools for liquidity providers LPs to maximize your earnings and trading fees by concentrating liquidity. Meteora Top Services, DLMM, stands for Dynamic Liquidity Market Maker. These are pools created for allocating and concentrate liquidity in discrete price beans. These are the beans. It's a price range, and you concentrate the liquidity on a certain number of beans. It supports single token liquidity provision and are highly flexible during market volatility, enabling better returns for providers. Dynamic vaults, automated vaults that rebalance assets such as stable coins like USDC or native tokens like Sol. Dynamic meme coin pools, specialized pools optimized for meme coin trading and launches, featuring liquidity locking to build trust, dynamic fees ranging from 0.15 to 15%, and protocol fees of 20% of commissions. These pools powered Trump and Melania coins early in 2025. Other liquidity pools are DAM and DBC. DAM stands for Dynamic Automated Market Maker and has version 1 and 2. And DBC stands for Dynamic Bonding Curve, that are for token pricing and launches. So, for example, some coins. Okay, so coins can be launched here just like pump.fun. Launch and development tools. Features like quick launch for easy pool deployment. Metsumi, a playground and assistance for testing and experimenting with programs. DLMM are pools that are a smart way to provide liquidity on Meteora, the DeFi platform on Solana. They let people called liquidity providers earn fees by helping others trade tokens, but in a more efficient and flexible way than traditional pools. Think of like a marketplace where you can focus your money where it's most useful, adapting to market changes for better returns. Okay, so core ideas is that you concentrate your liquidity. It has a bean structure. Liquidity is split into small beans, each like a bucket with a fixed price level. Active bean. Only one bean is active at a time. It's the one that both tokens available for trading where all the action and fee earning happens. Each bean follows a simple math rule to balance tokens. Market movement. When trading depletes one token in the bean, the pool automatically shifts to the next bean, updating the price. Okay, but what happens when a Solana Meteora DLMM active bean moves out of range for a trade for a token buyer? How the final price is calculated? So this is the formula. So the final price is calculated taking into consideration all beans involved. It will calculate the total amount paid of token Y, including fees, divided by the total amount received of token X. This can lead to price impact, effective slippage for large trades as later beans have progressively worse prices for the buyer. Features. The idea that support DLMM is high capital efficiency. Higher capital efficiency and fees for LPs. DLMM can support high volume trading with low liquidity requirements through the concentrating of tokens at or around the current market value. Flexible volatility strategy. Greater flexibility and control for LPs when it comes to efficient liquidity distribution. Capture higher fees unlocks more opportunities to capture higher fees based on market conditions. Dynamic fees. Fees that increase or decrease depending on how volatile the market is, which in turn help offset losses that LPs may experience in volatile markets and enhance LP profitability. Okay, but how does it work? Users can select token pairs that they wish to provide liquidity for. For each token pair, they can choose a liquidity shape that best suits their strategies. You can use a spot, that is you put the equal amount on consistent beans. Bid-ask, that is better for volatility, and curve, that is better for the stable pairs, okay? How dynamic fees work? Dynamic fees adjust like surge pricing based on market swings. A token launch, high demand or volatility spike fees, protecting against sniper bots and boosting earnings for token creators and LPs. Fees have two parts: a base fee set by the pool creator and a variable fee based on price changes and trading activity. Fees are split fairly per bean, and LPs can claim them at any time. You are the house. Bean price. Liquidity is distributed across discrete beans with a fixed width and fixed price. Each bean represents single price point, and the difference between two consecutive beans is the bean step. Bean steps are calculated based on the basis points set by the pool creator. For example, in the Sol USDC, if the current price is 20 and the bean step is 25 basis points, then the consecutive bean will be the first bean $20. Then, as we say, is 25 basis point is 0.25% increase of price per bean. So you will multiply the bean 1 to get the bean number 2 of $20 times 1.0025, and this will be the price that you will trade the token on the bean 2, and then the price of bean 2 will took to bean 3 and multiply it for the increase in price. Liquidity pools are identified by their tuple of pooled assets: token X, token Y, bean step S. Each bean represents a single price point, and the difference between two consecutive beans is the bean step. So here we can see this is the active bean. So it has this quantity of token X and this quantity of token Y. If the price of token X decreases to the bean number 13, you will transition to the price 13 or the bean 13. So anytime a trade, people buy more token X or sell token X, if you concentrate your liquidity between this bean and this bean, for example, you will earn trading fees from all these beans. So the idea is to concentrate the liquidity between very short ranges so you can maximize your capital. Okay, so you can add liquidity to beans into a position by adding in three formats. The spot provides an uniform distribution of liquidity. Curve, ideal for concentrated approach that aims to maximize capital efficiency, primarily for stable or pairs. Bid-ask, that is the inverse curve distribution where most of the capital is allocated towards both ends of the range. This strategy can be used to capture bigger volatility swings away from the current price. This strategy can be used to capture bigger volatility swings away from the current price. Bid-ask is more complex than spot and may require more frequent rebalancing to be effective, but has a high potential for fee capturing during situations where price fluctuates wildly around the current price. Bid-ask can also be deployed single-sided for a dollar cost average in or out strategy. Okay, so this is the way you allocate your capital in your range of beans using curve. So it will allocate the majority at the center near the current price. So this is great for stable tokens, but it has increased risk of impermanent loss. Then the bid-ask power to capture volatility, but is riskier than other positions, and it requires rebalancing to remain efficient. Finally, the spot is the ideal for almost all the time. It's ideal for stable coins and maximizes assets efficiency, but its disadvantages are that it has the highest risk of impermanent loss when price leaves the bean range. If used in volatile pairs for capturing greatest amount of fees, make sure to monitor very closely, as this strategy has highest risk of impermanent loss. Okay, but when bid-ask curve is good, for example, for USDC Sol, that is one of the main pools, is good. Okay, so Strong points about this strategy is that captures market volatility. It earns more fees during large price swings as trade hit the concentrated ends. Is riskier than other positions. Higher exposure to impermanent loss if prices moves outside the range. Requires frequent rebalancing to stay efficient. Great dollar cost average in out positions, enabling single-sided setups. Provide only USDC or SOL to gradually buy low or sell high as prices fluctuate. When it's good for USDC SOL pair on high volatility scenarios, ideal when SOL is volatile and is expected to swing widely against USDC stable. For example, during market dips or rallies, the ends captures trades, allowing you to DCA into SOL, accumulate more SOL as price falls, or sell as price rises while earning fees. What is bin step? A smaller bin step allows you to capture more volume, but your max price range per position is smaller. A general rule of thumb is smaller steps for stable pairs and larger steps for more volatile pairs. Larger bin step allows you to set a wider price range per position, but at the cost of less volume. Since there's a less continuous price range, it's harder for liquidity to be picked up for swaps. Important for highly volatile pairs, where price swings can be huge. For highly volatile pairs, larger bin steps could also mean less errors. Since with smaller bin steps, a trade may jump between different bin rates frequently. Note, currently max number of bins per position is 69. If you need to open a very large amount of bins, you will need to open multiple positions. Okay, so also important to notice, let's check some Meteora top tools. Metlex.io. You can create the famous P&L cards that are visuals of the profit loss of a current position. Metlex.io. You can create P&L cards to share and create a profit loss visual from a transaction, a create position and close position on a DLMM. Pool search. You can find pools with fees, bin steps, and row checks. Fees tracker. Monitor total wallet fees from positions. Top pools filter. You can rank and filter high fee DLMM pools by comparing volume to total value locked. Notification bots. You can subscribe with Telegram and Discord to get alerts for new DAM and DLMM pools. Toclio. You have real-time analytics. You can track total value lock, volume, fees, liquidity, and risk for DLMM pools instantly. You can filter pools and customize searches with base fee, age, bin step, and more. Fee and total value locked ranking. You can rank pools, projected raw 24-hour fee to TVL ratios for high yield spotting. Risk assessment. Evaluate pool risk with on-chain data for safer LP decisions. And pool screener. Discover trending high volume DLMM pools with single best per token views.